we put together a market update, kind of an overview of the market. One of the things that I always tell my students is that you have to be a student of the market because the market is always changing. And if you don't change and evolve with the market, then the market can leave you in the dirt. In 2008, the market changed pretty dramatically, okay? And when those very dramatic changes happened, most people kept doing the same thing and hoping for what? Different results, right? They kept hoping that what was working before would continue to work, but it didn't. And the people that really got wiped out, I mean, literally a lot of people have been wiped out over the last several years, were the people that did not change with the market. So you've got to understand the market, you've got to be a student of the market, you've got to evolve with the market. Right now, the market has aligned itself in a very unusual way. The lending situation and the buyers versus sellers, this is, and the amount of equity in homes, this is something we haven't seen before. And these unique alignments of market parameters create unique opportunities. That's why most of us are here for the mortgage assignment program. It's interesting, I was talking to somebody in the back before, and he was saying, this wraparound mortgage stuff and these assignments, this is kind of like what it was in the 80s. And it's interesting, back in in the early 80s, I think it was 81, interest rates got all the way up to 18%. Imagine mortgages at 18%. Well, the situation then was very much the way it is now. I mean, technically the banks were loaning, but at 18%, for all practical purposes, there was no loaning going on, right? Because, nobody could afford to borrow at 18% interest. So loaning came to a grinding halt. And a lot of people were doing creative real estate transactions back then. They were doing assignments and what we call wraparound mortgages and some of the stuff we teach. It's interesting. A lot of people in this country are actually giving me credit for inventing all of the stuff that I'm talking about. No, most of this stuff was used before. It just hasn't been used in 30 years. The people who weren't around back in the 80s, it's all new. And when I've been teaching this, it's interesting that this has been a very difficult topic to teach. I don't know why, but I explain it, and people don't get it. They just don't get it. But the one exception of the group that really gets it, the group that was doing this, the realtors and investors back in the 80s, they get it. They're like, oh, yeah, I've done that, I've seen that before. Anybody that started this business after the 80s, it's all new, and never seen that before. I'm not sure that makes any sense. So it's been very interesting. But the point I'm trying to make from all of this is that you have to be a student of the market. If you study history, if you study the market, and you remain a student of the market, you're going to not find yourself in a situation one day where what you were doing no longer works anymore. You're going to understand why it doesn't work, and you're going to be able to evolve and adapt new strategies based on the history to help you go forward. So it's important to study history and study the market and remain a student of the market. And that's what we're going to do today. So let's talk about the real estate market. We can't talk about the real estate market without saying welcome to the Great Recession, right? 1.4 trillion, that's with a T, annual deficit, 2.2 trillion federal balance sheet. Approximately $3.5 trillion has been spent on all the government stimulus plans. Nearly 1/3 of homeowners have negative equity, underwater. 1 in 6 are either underemployed or unemployed. 1 in 7 delinquent on their mortgages or already in foreclosure. Small business failures are up 44% year over year. 20 to 30% slide in home prices. Obviously, it's different in different parts of the country. 50% plunge in commercial real estate value. So we've just been through a tsunami, right? This is just like the Japanese tsunami, although this has been an economic tsunami. Some of the indicators of economic health. Consumer confidence is weak. This is one of our biggest problems. We have this quirky scale. We actually measure consumer confidence on a 0 to 130 point scale. And in 2007, July, it was at 110. it dropped in half to less than that half, which was around 50, and it's been bouncing around that ever since. Nobody's sure kind of what's going to happen next, and the confidence really hasn't come back yet. Stock market went from 14,000 to 6,600, now a little around 12,000. Personal consumption, which represents about 70% of the economy, we are a consumption-based economy, is showing some signs of recovery. So that's a good bullet. Retail spending is up, and if you take a look at just the economic indicators, what's been going on for the last couple of years is you get some good news here and some bad news there, and then you get a couple of pieces of good news and got a couple of bad news, and it's just kind of all over the place. Here's the consumer confidence numbers, and you can see, we normally have confidence somewhere around the 100 range, and then boom, this is when the Great Recession hit, and in 08 it plummeted way down, all the way down to 30, and then it bounced around 50, and that's kind of where it's bouncing today. Unemployment and underemployment. The government's actually playing a lot of games with the numbers. Right. Some people would say they're cooking the books. They actually, the way they're measuring things like inflation and unemployment, for example, unemployment, we're talking about that one. When they measure unemployment, they're actually taking out of the measurements all the people that lost their jobs, got unemployment insurance, but then the unemployment insurance ran out. So you're not being counted anymore if you're unemployed and you want a job and you're not getting unemployment insurance, which doesn't make any sense, right? I mean, they're still unemployed. They're still technically looking for jobs. So because of the way they measure things, the headline number of unemployment is around 9%. But if you include all the people that really want to work and really can't get jobs, it's actually closer to 16%. So there's a lot of people out there that have no jobs and want to work, and that's obviously one of the biggest problems that we're facing right now. And of course, the government's response to the whole thing has been, bail them out, right? Let's bail them all out. In 1990, by the way, the government seized the Mustang Ranch brothel in Nevada for tax evasion. And as required by Nevada law, they tried to run it, they failed, and it closed. Wow. So if you think about it, we are now trusting the auto industry, the banking system, and healthcare to the same nitwits that couldn't make money running a whorehouse and selling whiskey.
Oh, that's good. That's good. That is so good.
That puts it into perspective. So welcome to the Great Recession. All right.
God,
so the hurdles. What are the hurdles? Major hurdles for 2011. Okay. State, local, and school districts falling revenues. Everybody's heard about the Wisconsin situation and much in this part of the country, actually, and even the rest of the country. The states are, broke, and they're having to balance their own budgets. The states don't have the same advantage that the national government has of being able to print their own money, right? So when they don't have enough money to pay school teachers and firefighters and for whatever other things they want to do, they have to start making those hard decisions that the federal government doesn't have to make. And so there's a lot of layoffs and cutbacks and budget adjusting going on at the state level. Credit contraction continues. This is actually one of the biggest problems. The government's printing money, and the money supply is growing. We're going to show you some charts on that tomorrow. But credit is contracting faster than the money supply is growing. So the amount of money that people actually have, the capital, is actually going down. So how many people here, I'll give you an example. I'm going to tell my story first. I actually have a number of credit lines. I use credit lines to fund my business, right? We borrow money out of our credit lines and buy houses, renovate them, fix them, flip them, do whatever. And so I constantly have money I'm taking out of the credit lines, paying off the credit lines. And I had, for example, 2 business credit cards, and they both had a credit line of around $50,000. What I would do is I'd take the $50,000, I'd spend it, and then at the end of the month I'd pay it back again. And I'd do this over and over again, like any credit card. And one month I get a call from my bank, and the bank says, oh, Mr. Grove, I'm sorry to inform you, we're actually reducing the credit line. This is right after I paid off the credit line. I said, really? You're reducing it to what? Well, we had to reduce it from $50,000 to $1,000. Why? I don't know. I have perfect credit, never missed a payment on anything in my life. The banks are simply not loaning money anymore. So how many people here, raise your hands, have had credit lines reduced? Okay, look around, everybody. Okay, that's what's happening. Credit is going away. I have advice for you. It's probably too late for most of you, but if you have a credit line, don't pay it off. Do not, that's serious, do not pay back any credit lines. Once you pay it back, it's gone. Okay? We have a comment in the back.
Phil, just to let you know, that doesn't actually always work because we had a credit card. They lowered the credit limit and the balance was actually above what the credit limit was. So that doesn't necessarily matter.
I would still try it. I mean, I have another situation. I'll give you another example. I have a $2 million property, and on that $2 million property, I have a $400,000 line of credit. Okay? So it's a 20% loan to value. I mean, would you call that a secure loan?
Yes.
Somebody who's got good income and perfect credit is borrowing $400,000 against a $2 million security. Does that sound like the kind of a loan a bank would want to make? Yeah. The bank called the loan. Okay. Why did they call the loan? They called me up and they said, we don't want to do that loan anymore. Well, why not? I have perfect credit. I've never missed a payment. I'm a good customer. You said I was a good customer. You even assigned some special banker just to me and everything else. And sorry, we're just not doing those loans anymore. So what am I going to do when we want our $400,000 back? Well, $400,000, I have a growing business. I'm hiring people. Business is doing well. I've got multiple projects going at all times. If I just write a check for $400,000, that's $400,000 of less money I can use to help the economy, right? You know, to hire people, to buy and sell houses, renovate and do all these things. That would be very disruptive to my business. So I've actually been negotiating this for the last 2 years. And the way the negotiation does is they call the loan and I send them $50,000. They let me go for 6 months. They call the loan and I send them $50,000. So I've been paying it back in $50,000 chunks over the last 2 years. I'm now down to $200,000. They're still calling the loan. Okay, you know, it's really, really criminal what's going on. A friend of mine actually has a granite business. I mean, this is how bad things have gotten. He has a granite business, and the business it's very capital intensive. What he does is he buys, you know, big sheets of granite. Whole quarry, big lots of it, a lot of it. And then he hires a bunch of fabricators, he installs it in a subdivision, and then he gets paid back by the builders out of the bank draws. And when he does one of these projects, he has to put about $250,000 out of his pocket. He's got to put the $250,000 out up front to pay for all the granite and to pay for the fabricators and installers to install it. So that's what he did. He put his $250,000 out, he installed all this stuff, he put it all into the houses, and the banks came back to the builders and said, we're not paying on the draws. The builder said, what are you talking about? These are loans you guaranteed in advance. And the bank says, I don't care. You know, we're not putting any more payments out on the draws. We're not going to pay on the draws. So the builders couldn't pay the contractors. And my friend, who's had a very successful business for 20 years in this business, had to declare bankruptcy. Okay, bankruptcy. I mean, this is a, you know, contributing member of society, an entrepreneur like all of us. He did everything right. He never broke any rules. And the banks, who had a contractual obligation to pay these debts, you know, stop paying on the loans or on the draws and wipe them out. And you know, that's the problem. The society, we need capital to grow our businesses, right? You can't very well or very easily grow your business without capital. And capital has gone away and is going away. Will that change? Yes, that'll change eventually. You know, eventually, like we talked about yesterday, the banks will become solvent again, and some guy at Bank of America is going to wake up someday in the future and say, what's that business? What's that thing we used to do? Lending. Yeah, that's it, right? You know, let's try that again. So it'll change, but it's a big problem now, and that's maybe the biggest problem, in my opinion, that we have. Jobs, income, spending, pending changes, laws, regulations, and taxes. This was a big problem at the end of the year when they weren't sure whether or not they were going to extend the Bush tax cuts, whether you believe in that or not. The point was that the capital gains rate and a bunch of the tax rates were up in the air right up until the very end of the year. And, you know, businesses couldn't make decisions about what they wanted to do because they didn't know whether the taxes were going to be higher or lower one year versus the next. So uncertainty makes a lot for a lot of instability in the markets. Extend and pretend is what's going on in a lot of the banking system, especially in the commercial space. You know, the loans sometimes mature, and the banks have a choice of calling the loans or just extending the loan. And a lot of times what they are doing is they are extending the commercial loans simply because if they call them, they know it's going to cause a bunch of defaults. They don't need defaults. The loans are maybe not secured properly because the assets have gone down so much in value. So they're just pushing it off into the future and hoping that values go up again. Foreclosure gate has been a big issue. Everybody know what foreclosure gate is? Not everybody. The banks are so overwhelmed with all of the foreclosures that they tried to automate some of the foreclosure processes, and they did what was called robo-signing, which was more or less having machines, you know, sign all the documents, which were not supposed to be signed by machines. I'm simplifying the explanation a little bit, but the point is that some attorneys and some people in the government said, no, you can't do it that way, and in the auspices of being consumer advocates, they shut down the foreclosures at the banks, at least temporarily. You know, in my humble opinion, every time the government has stepped in trying to help the problem, they've made it worse, okay? So what happened? Well, all of the big banks put a moratorium temporarily on foreclosures, so the number of foreclosures went whoop, and then they got their act together with their paperwork after about 6 or 8 weeks, and then the foreclosures went, off the charts. So all we're doing is moving around the furniture on the deck of the Titanic, okay? That's really not helpful. The same thing with the, first-time homebuyer tax credit last year. I mean, it seemed like such a great idea. The government would pay people a credit if they bought their house before April 30th. And what happened was what? Anybody who was thinking about buying a house and would qualify for that last year, they moved up their purchase. They bought it in April, and then after April, nobody bought because everybody that was going to buy, bought early, and then the end of the year, went off a cliff. So moving things around, having people buy in this month versus that month, having a bank foreclose, in January versus December, it's not going to help anything. That's just spending enormous amounts of money to, again, rearrange the furniture, and you really need to let some of these things just work their way through the systems. But that's kind of been the response that we've been dealing with. And there's, of course, a lot of psychological, malaise about what's really going to happen and what's going on. Some of the housing trends, tax credit and subsidies ended last year. Household creation is very, very slow. We're not building houses anymore because there's not capital. A comment in the back.
About the tax credit, I don't know if you've seen it or anybody else, but the IRS is calling back 2009 on the new home buyer tax credit. It's like $2.5 billion.
They're calling what?
The refunds back from everybody. There was a discrepancy.
So some people didn't do it correctly?
The IRS didn't do it correctly. There were two different. It's ridiculous. I'm sure that's going to help a lot of things too, right? Well, we're talking about the trend.
Yeah. So some more rearranging of the furniture going on there. Household creation, though, there's no capital. People are not building. I'm exaggerating a little bit, but building is way, 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 way down. Generational housing preferences are changing. This is a trend to take a look at. What does that mean? Kids are not buying a house when they get out of college, right? Instead, they're renting. I mean, the idea of renting over buying is changing. Parents are sometimes moving back with their kids, and people are doubling up in a lot of ways that they did not before. Purchase mortgages are much more difficult to obtain. We all know that, right? Very, very tight underwriting. Hard to get loans. Renting is a more viable option. Appraisals are a major issue in purchasing homes. I am having a lot of trouble with appraisals. And the reason is the appraisers are scared to death. The message went out to the appraisers: if you appraise something wrong, you're going to, lose your job. You're going to go to jail. And we have some appraisers in the room. Who's the appraisers in the room? Yeah, pretty scary, right? The kinds of things they're telling the appraisers. And as a result, the appraisers are being uber conservative. And this has hurt me on a number of occasions. I had a house not long ago. I put the house on the market. It was beautifully remodeled. It was the nicest house in the neighborhood, and the house was worth $110,000. It was worth exactly $110,000. The house next door sold for $115,000. The one on the other side sold for $105,000. This one was $108,000. This was $112,000. My house, which was right in the middle, exactly worth $110,000. And I know what things are worth. I've been doing this a lot. I know what things are worth. Everybody agreed it was worth $110,000. The realtor agreed it was worth $110,000, and the buyer agreed it was worth $110,000. And they made a $110,000 offer. I accepted it, and life was good until the appraiser showed up, and the appraiser said, "Nope, it's only worth $105,000." And at that point, everybody knows what the appraiser appraises it for. That's as much as the bank will lend. So I had to drop my price $5,000. That came right out of my pocket, because there was no way the bank was going to allow the house to be sold for $110,000 once the appraisal came in at $105,000. And I've had to do that 2 or 3 times on houses. That's the way it goes. So if you have a property and you're hoping to sell it, if the appraisal doesn't come in, you're going to have to drop your price, even if everybody agrees, even if the buyer, the seller, and everybody agrees to sell it at that price. I actually had another funny situation. I'm going to ask my appraisers in the audience what this is all about. I had a property that I bought. I got it really cheap. I owned it for a little while as a rental. I wasn't sure what I was going to do with it, and I decided to just go ahead and sell it. The house was worth $155,000. I know it was worth $155,000. Again, this was $160,000, this was $140,000, this was $130,000, this was $170,000. Mine was right in the middle. Mine was worth $155,000. But I just wanted to get rid of this house. Somebody came along and they offered me $125,000. I said, fine, you can have it, $125,000. If you close quickly, you got it. So I was willing to sell it for $125,000. The buyer wanted to buy it for $125,000, and the appraisal came in at what? $155,000. It was an accurate appraisal. Good deal. The bank turned down the loan. They said, why would you sell a house for $125,000 if it appraised at $155,000? So they ordered a second appraisal. The second appraisal came in at $155,000. The bank said no. They ordered a third appraisal. The third appraisal came in at $155,000. Yeah, it was a $155,000 house. So maybe you got to tell me, why would a bank turn down a loan if it appraised above market value? Do you know?
You don't send an appraisal in for something different than the sales contract is.
But that's happening all the time.
Well, when I order an appraisal, if I have a sales contract for $125,000, that's what the appraiser has to give me. And I know it's worth $155,000.
But they can't. Yeah, they can't. The truth is, that's the way it used to work. It used to work that way. It does not work that way anymore. It used to be that there was kind of this wink, wink, nod, nod. The appraisal would always come in at the sales price. The appraisers have been scared to death. No, don't look at the sales price. Come in with a fair appraisal. And these appraisers did. But what I can't understand is the appraisal's too low, I get gypped. The appraisal's too high, I get gypped. So every time I get an appraisal, I start to shake. It's like, oh, something bad's going to happen. So there was a comment in the back.
I know they're doing it exactly what I said yesterday, because they know where the trend is heading. It's heading down. So if they're going to appraise it,
it's not heading down. No,
it's heading down.
No, it's not. But so I don't know why. Do you have a theory?
Well, not any more than some of the other things that call them a $400,000 loan on your open credit. The thing is, we are directed by federal laws and not state or anything else. And I think it's probably going to get worse because under the new Dodd-Frank. Now what the banks are doing is they're actually taking tellers. They're going to run through a quick cram course on how to review an appraisal. And now anyone can turn the appraiser into the federal government on that level.
Yeah.
And they've got hourly people that are going to be reviewing something. They have no idea what they're looking at to start with.
So the lenders are turning the screws on the appraisers, and it's probably going to just get worse rather than get better. So
I just have a theory.
Okay.
Is that I think with it coming in higher, they're thinking that there's some sort of red flag. There's some problem with this property.
yeah, and they ordered 3 appraisers, and
Right.
I explained to them 16 times.
Yeah.
But I actually know the real secret because I actually hired some investigative reporters, and we actually went inside of Bank of America, and what we did is we snuck deep into the bowels of Bank of America to figure out what the actual lending procedures are right now, because we're all trying to figure this out, right? How do we know when they're going to make a loan and when they're not? And here's what we discovered, and the video is so shocking that I can't actually show it in front of this room. But when we got into the decision-making heart of the bank, what we found was this twister board that was on the ground, with the red and the green and yellow things. And on each of the different colors, it said, make loan, call loan, deny loan. And they had these crates of chickens. And what they would do is they'd take a chicken and they'd cut its head off and let it run around on the twister board. I'm not making this up, folks. We're hoping things get a little more sophisticated in the future, but that appears to be what's going on for the time being. So, alrighty. And people are scared. So getting back to the reality here, people are scared. They don't know which way the market's going. A lot of people are worried, maybe prices will continue to go down, and that's why people are scared to buy. Okay, some charts. And by the way, I'm telling everybody, be a student of the market. We try to put the sources for the information down at the bottom of the chart. You can find this information yourself if you want to stay abreast of what's going on out there. So welcome to the housing bubble. This is what happened from 2000 to 2000 and end of 2007. Prices skyrocketed at an unprecedented level, and then in 2008 we had a correction through 2000, end of 2009, and we lost 6.2 trillion with a T, in home equity. That was about half of all home equity got wiped out with the correction in the market. And just to put that into perspective, the entire gross domestic product of the United States, the sum of all goods and services and products of all everything sold in the United States is 14 trillion. We lost about half of the GDP in one bold swoop. So it's been a major reduction in wealth is essentially what we've lost. Of course, the big problem is mortgage defaults and mostly subprime mortgage defaults. So the lenders had this idea that making zero-down subprime loans was a good idea, and it didn't work out so well. And now about 25-26% of those mortgages are in default. I remember, and by the way, my grandfather was a small-town banker in western Kansas. And, I grew up, I was told when I was young, how do you buy a house? You put 20% down. That's what I was told. I grew up believing that. My father grew up believing that. My grandfather was a banker, so that's what he did. And I remember when I got into the real estate market, and I was talking about kind of what's going on in the real estate market, I told my dad, yeah, most people are getting in zero down now. My dad said, what's that? Oh, well, they buy a house and they can get it for zero down. And I said, well, you can't buy a house with no money. He said, yeah, you can get a loan with nothing down. My father didn't even believe that was possible. He was a sophisticated man, but he'd never heard of such a thing. It's like, well, that's not going to work. You're right, Dad. Seemed like a good idea at the time. So, Foreclosure filings. Okay, this is something to also keep abreast of. Now, here's something I'll tell you about foreclosure filings. This is a lagging indicator, okay? When you start to see a change in this number, you know we've really gotten past the worst of it. It's one of the most lagging indicators. And it's still on a pretty sharp increase. I'll also say something about foreclosure filings. This is very volatile. From one month to the next, the numbers are way up, the numbers are way down, so it takes many months to actually see a real trend. But obviously, you know, foreclosures went from, you know, 40,000 a month all the way up to 160,000 a month, you know, a 4x increase in the number of foreclosures, which, you know, is just very obviously significant. And this is probably the most significant chart in my opinion. This is really what tells you what's going on in terms of lending. New single-family homes, that's new construction of single-family homes, is down 78%. So pretty much there's no money and there's pretty much nobody building homes anymore. And you've also got existing single-family homes down about 21%. So combined, the number of homes actually being sold has gone down dramatically. In fact, the number of units of homes sold, the number of houses sold each year, is we're back to about the level it was at 1995. So that's where it's gone. So for all the realtors, this is the problem, right? I mean, there's so many realtors, and we actually have more realtors now than we had in 1995, but they're competing for the same amount of money, okay? So realtors are sucking wind being realtors. I mean, there's always the top 20% or whatever, but in general, you know, when a larger number of people are competing by a lot, are competing for the same amount of money, you know, there's a major problem. I've heard some statistics, like the average realtor has 2 listings a year or some crazy thing like that. I mean, some people have a lot more, but it's pretty ridiculous. So that's really what's going on. There's not that much lending, there's not much buying, there's not much selling, there's not much building. There's just not much going on. There's just a lot less stuff going on. Now, it doesn't mean there's not a lot of people that want to sell their homes, but there's just not that many homes actually being sold and bought. And of the homes that are being sold and bought, which isn't a lot, about 35% of the market for sold homes is the distressed market. So if you have a home and you're not a distressed seller, you know, your odds are not all that high that you're going to be able to sell the homes, because this is your competition. You know, when somebody buys a house, they don't care if you're rich or poor, distressed or not, REO, foreclosure, short sale. They just want what they want. You know, they want a deal and they want what they want. And you're competing with all of this inventory, distressed sellers and short sales and REOs. That's the competition. Number of housing units and vacant houses held off market. Okay, this is also known as what's called shadow inventory. How many people know what shadow inventory is? Okay, not everybody. Let me explain what shadow inventory is. Shadow inventory has been around a long time for things like the condo market. And anybody who's followed me in the Revolution training, you probably know I'm not a big fan of condos. Okay, condos I always consider to be what I call a canary in the coal mine. It's the first thing to go and the last thing to come back. So if you can sell a condo, you know you're in a good real estate market, okay? If you can sell a condo, you can sell anything. Otherwise, and that doesn't mean it's impossible to make money in condos. I mean, I know people have made money in condos, but it's the canary in the coal mine. And what's always happened with condos is, you know, when somebody builds a building, and this is why the numbers can be very misleading, especially with condos. When somebody builds a building and they have 200 condos in the building, right? And they need to sell these 200 condos. They don't put 200 condos in the MLS. They put 3, okay? They put one on the 6th floor, and then they put a penthouse unit in the corner, and then they put something on the 9th floor, right? And those are the 3 condos they put in the MLS, because that's all they need to put in the MLS for advertising purposes. So somebody sees, oh, I condo downtown, whatever. They go to the building, they look at the one on the 6th floor, and they say, I don't know if this is what I want. And immediately the salesperson says what? Well, we've also got one on the 7th floor, the 8th floor, the 9th floor. We've got units in the middle, in the condo, double bedrooms, triple bedrooms, penthouse, what do you want? Okay? So there's a lot of inventory. Sometimes, you look at the market and it says, you remember we talked about months of inventory yesterday, sometimes it says like, there's only 200 condos available in the MLS. Well, there may be actually 2,000 condos in the MLS. The other 1,900 of them could be, shadow inventory. Okay, just inventory that is actually available, competing in the marketplace, that is not being advertised because it doesn't need to be advertised to get the clients to see it. There's other types of shadow inventory, and this varies by state and location. California, there's a lot of this. In this part of the country, there's probably some, like in Michigan, there's definitely shadow inventory. Some of the bigger hit markets have more shadow inventory than others. What's happening is with shadow inventory, sometimes when the banks foreclose on properties, most of the time what the bank does when they foreclose is they immediately hire a realtor and they put it back on the market as an REO, real estate owned, bank foreclosed property. But sometimes what the banks do is they say, wow, we've got all these foreclosures. If we dump all of these things on the market, it's just going to cause the market to tank. So instead what we're going to do is we're going to hold back some of this inventory. When we sell a few, we'll put a few more on. When we sell a few, we'll put a few more on. And what that's doing is it's just keeping the market from getting more healthy, right? Because every time you start eating through some of the inventory, because that's really what needs to happen. We need to burn off the inventory. We need to get all of these problems, all the distressed homes, all the subprime mortgages, all the foreclosures. They all need to be foreclosed, renovated, sold, moved out of the system. And it's going to take a long time to do all that. And the fact that, there's shadow inventory being dumped on as the inventory clears, just means it's going to take even longer than people think. Okay. Annual median existing home percentage change. Obviously, we had a big change in home values when the correction occurred. Another look at the housing bubble, and I'm going to show you some charts tomorrow when we talk about building wealth in real estate that illustrate this as well. But, and the trend went back. For many, many years. We've always had housing bubbles, and the housing bubbles always look the same. They go up, they go down, they go up, they go down. We just had a, mega bubble, okay, that was fueled by subprime lending. So housing prices shot up through the roof from 2002 to 2007, and then they plummeted like a rock from 2008 to 2009. And they're pretty much bouncing along the bottom. Now, what's interesting, and I'll show you again some more charts tomorrow, is we've corrected, okay? We've corrected in a big way, okay? Prices are back where they would have been had we never had a bubble. Now, I'm not going to speculate are prices from here going to go up or down or right or left. There's a lot of things that are going to factor that. But there's a lot of, data. And if you look at how bubbles have always corrected in the past, what it would say is we've had a correction, it's been a major correction, we may have even overcorrected a little bit by historical standards. Prices are back where we would have expected them to be. Where they will go from now has to do with which economic theory you are signed up for the future, and there's a lot of those. National Housing Affordability Index. Here's the good news, right? Loans are super, super cheap, and prices have come way down, which means what? Houses are more affordable than they have been in years. Yeah?
And your last comment, which theory do you subscribe to?
Well, I'm reluctant to speculate for the reason of this. I know people that will argue passionately, the government's printing money, hyperinflation, this and that, and we're going into another double-dip recession. No, we're going to pull out of it slowly. The only thing I'm absolutely personally certain of is that nobody knows for sure. I really believe that. I know people that really believe it's going to do this and this and this, and I don't believe that anybody knows.
What do you think?
I think eventually, I'm personally betting that eventually we're going to have some significant inflation. That's what I'm personally betting on.
In the next 3 years.
What's that?
In the next 3 years, what do you think?
I don't know. I really don't know. I think it's going to happen. I don't know if it's going to be 3 years from now, 5 years from now. It's funny though, because I have my father and some other guys that are kind of in their 70s, and I have conversations with guys that are older and wiser than I am, and they have just this gut sense, and their sense has always been, you know, we're going to see a big one. You know, there's going to be something big that has a result of all of the government deficits and stimulus and printing money, but they also say, but it's not going to happen in our lifetime.
Well, so we're talking about the shadow inventory, and you're right, it's a control valve. But they're adding more on than they can let out, so they got back pressure coming up. And I know they're predicting the max, I think, 2013 before they come close to bottoming that out, and they're going to be dumping it this summer.
Yeah, they're dumping shadow inventory all along. But shadow inventory, by the way, does not exist everywhere. It only exists in some markets.
And what about your area?
In Austin, Texas, where I live, there is no shadow inventory. So, yeah. Except maybe some condo inventory. So anyway, I mean, you know, good news, you know, housing is affordable. I mean, it really is. I mean, the interest rates, the rates they are, and the amount of correction we've had in the pricing, housing really is affordable. So the good news is, if you're actually one of those lucky people that can get a loan, it's the best loan ever. The houses are cheaper than ever. Of course, nobody's taking advantage because everybody's scared. Total housing using starts. This is new construction. New construction's fallen off a cliff. There's just not that much capital available to build new houses. I see that as good news, because the last thing we need right now is more houses, right? So I hope, you know, there's no capital for houses or no building permits issued or whatever. I mean, you got to let the free market do its thing, but we don't need more houses right now. And, you know, the big question is, how long is it going to take to clear out this inventory? And nobody knows. You know, we don't know exactly how much inventory there is to clear. Somewhere between 9 and 12 million units. If you take a look at the number of units sold back at 2009 levels, we're selling about 5.5 million units a year. That means we got about 2 years of inventory. Now we're also, right, putting more houses on the market, because we're not just selling the inventory. You know, hopefully more buyers are going to be coming on. So at what point, the real question that people want to know, will things start to look something like what we would call normal? And the answer is, it's not going to happen anytime soon, okay? I mean, the odds of it happening in less than 2 years are about zero, okay? How long will it take? We don't know. Nobody knows for sure. But there's a huge opportunity for things like mortgage assignment and things like that for at least the next 2 or 3 years. And there's a question far in the back.
Yes, my question is, what happens to the equity of someone's home? Because one day they have the equity.
What happened to the equity? Is that the question? What happened to the equity? Yeah, I mean, it's gone. It's just like stock, right? When the stock goes down, the money just disappears out of thin air. It's like you own some art, and all of a sudden it was worth $1 million, and now it's only worth $100,000. I mean, it's gone. You know, it was always on paper, and now it's not on the paper anymore.
Somebody has profited from that, right?
Somebody has what?
Somebody profited from that.
No, you don't. Nobody profits from the loss of equity. I mean, it's just paper that's disappeared. So, but it's been a major problem because for the last several years, people have been using their homes as an ATM machine, right?
Yes.
The value goes up, and we take out the equity in the form of home equity loans and refinancing and moving from one house to the next, and that has been billions or really trillions of dollars of extra money we've had to spend on stuff, whatever that stuff happens to be, and all of that's gone. Yeah.
Possibly local tax authorities. My house, lost value, but the appraisal went up.
Yeah.
The mill levy went up.
There's been, and the tax, I mean, that's one of the reasons why the state governments are,
right,
having a lot of problems, because in most cases values have gone down, tax collections have gone down, the amount of commerce, sales tax, all that's going down, and the state governments are spending the same amount, but they're taking in less money, so they're having to make some pretty serious cuts. And I know where I live, what's happened is the appraisal values have come down a little bit, but the lender, the government can play with the tax rate. They can play with how hard or soft they will be at negotiating prices. I mean, so there's games they can play to regulate their revenue. Was there a question over here somewhere? Okay.
How many people do you know that use the equity in their homes to buy more real estate?
Yeah, everybody. I mean, homes for the last several years have been ATM machines, right? Everybody's been getting wealthy on paper and taking the money out. And so, half the GDP disappeared, right? Gosh, it's going to take a long time to, find our way out of that. I mean, all the ramifications of that